It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Last week, I got a lot of attention and a lot of responses, and I do appreciate all the feedback. I did state at the beginning of last week's show that I had difficult information to share that, well, many of you would not like hearing. At the same time, I didn't want to sound alarmist, yet I am concerned. There's so much of that goes on these days where precious metals, identity theft, proponents of those types of things tend to take a really alarmist approach. I try not to do that. I am at heart an optimist, and I do want to say straight up, long term, I am very optimistic about the future economy of the United States and the markets and all that type of thing. But as I continue to look at what's going on, I'm increasingly becoming more and more pessimistic of the short term. There are a number of reasons why, and I'm going to share even a few more of those this week. If you missed last week's show, the title was "The AI Bubble is Starting to Show Serious Signs of Cracking." That is continuing as we speak. But before I go to that, I need to address these IPOs that are coming up, because these are massive liquidity events that could also have a real impact on the markets in general. For example, if you realize that Apple went public in 1980 at 15 times revenue, SpaceX wants you to buy at 100 times revenue. This isn't getting in early. A lot of people believe this is an exit for venture capitalists who've held this equity for years, oftentimes at a fraction of what you're being asked to pay. There is a lot of attention and excitement about the SpaceX IPO. It's increasingly looking like this could end up being the largest scheduled cash out in modern market history. And it's not just me thinking this or having this opinion. Many other experts do also. SpaceX is set to list on June 12th at about $1.5 to $2 trillion valuation. That instantly makes it bigger than Microsoft and puts it only behind Apple and NVIDIA in the entire U.S. market. Now, SpaceX posted over a $4 billion loss in Q1 of 2026 alone. Total losses since its founding are above $40 billion. Now, please understand, SpaceX as a company and an idea I like and support. In fact, I use Starlink Internet myself. It's a great product. I think, again, long-term, this company and its technology has a very bright future. But the prices that they're asking right now, in my opinion, are overvalued. From a historical standpoint, certainly they are. Now, currently, insiders hold about 95% of every share that exists, and normally insiders are frozen for 180 days after an IPO listing to stop a wave of selling, which would crush the stock price. SpaceX has thrown that rule book out the window. At about 60 days after the listing, 20% of insider shares will become unlocked. Now, there's certain benchmarks that if the stock hits, additional insider shares will unlock. And after the Q3 earnings, another batch will be freed up for insiders to sell. By late November, over 90% of insider shares could be sold. This is why many are looking at this not so much as an IPO or a real opportunity, but as more of a carefully scheduled insider exit that Wall Street has signed off on. Now, please understand, I'm not saying you should not invest in SpaceX. Here's something you need to be aware of about large IPOs over the past decade or so. Many have crashed hard after their listing. Planeteer lost 53%, Facebook 54%, Snap 56%, Coinbase 57%, Twitter 58%. Uber lost 68% of its value, and Lyft 79%. Rivian 88%, and Robinhood lost 90% of its value after its IPO. In fact, the average drawdown across major IPOs in the last 15 years was over 50% within the first year. None of these were small companies. Many of them were industry leaders, heavily hyped by the media, backed by top institutions, and considered must-own stocks even before their listing. History shows us that many retail investors enter during peak excitement periods. And although many of these companies were great businesses long-term, their drawdowns were significant before they eventually came back. And it's not just SpaceX. We have OpenAI, Anthropic, and SpaceX all coming out as IPOs in the near future. All three are deeply unprofitable and have trillion-dollar market caps. Now, there may be a short-term speculative rally and certainly a lot of hype around these three IPOs. But a major correction in their price at some point shortly after their listing is highly likely, and has definitely happened to other large IPOs in the past. You see, it doesn't really matter what the technology is. The technology can be good, but the point of a business is to generate a profit. The consensus by experts is these three stocks are extremely overvalued. And a lot of this comes down to where people get frustrated when you're referring to AI is either AI is in a bubble or AI will replace humanity and usher in a new utopia. And the reality is probably somewhere in the middle. Some of the AI systems are obviously useful. It can automate repetitive paperwork. It can make scientific discoveries faster. And if AI can detect a brain tumor earlier than a radiologist, by all means, use it. But the reality is AI going to replace everything? Education, art, human communication, spirituality, romance. That's less likely. And in fact, the more that the AI takes over, the more human interaction will become more valuable. Not everything that's inefficient is a flaw, and not every limitation needs to be eliminated. A handwritten letter is certainly less efficient than an email, but how much more impact does it have? And live music is less efficient and costs more than recorded music, but how much more do we appreciate a live band or an orchestra performance? And which is more effective, pre-recorded content when you're educating or an in-person teacher? You see, those types of things provide something that AI cannot, and it's called presence. A video recording is not as impactful as a in-person public speaker. Human beings are social creatures, and we do crave that interaction. And as we lose more and more of it, and AI takes over more and more of that human interaction will become more rare and will then become more valuable. So I'm not saying the technology is not valuable or even game-changing. But what I am saying is it's not just going to sweep. I don't believe that it's just going to sweep and take over everything in one quick fell swoop. There'll be bumps. There'll be setbacks. There'll be fits and starts. It'll be a rough ride at times. And we have a market that's priced for perfection. What happens if some of these disappointments or setbacks occur? Are you at risk? Do you want to protect yourself from that downside potential risk? Do you want to continue to grow your money if these tremendous returns do indeed continue, yet protect the downside or even lock them in before the downside occurs? Index growth annuity products allow you to do that. And this is the golden age of fixed assets. We're seeing the best numbers in over 40 years. The best index product I have seen in my 27-year career has just been improved recently. I'll show you index products with averages of the worst case scenario of 7.5% average returns over a decade to fit over 15% average annual returns in a decade over the last 20 years with no downside risk. There's no fee options and low fee options available. No cap, unlimited upside. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I'm going to discuss a few more of the warning signs of this market that's currently priced for perfection.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. You can reach me at yourpersonalbank.com. Email Ference, F-E-R-E-N-C. No E on the end. F-E-R-E-N-C. Foxtrot, Echo, Romeo, Echo, November, Charlie at yourpersonalbank.com or 866-268-4422. Now I'm going to wade back into the waters that does upset some people, and I do believe it is because it upsets a preconceived notion or narrative that many have bought into or don't want to pay attention or don't want to believe, or as some call it, hopium, hope things continue. At the same time, I don't want to sound like an alarmist and overreact to the other side. The reality is no one knows when the tops or bottoms of any market occurs. Warren Buffett is famous for stating that himself, and if there was anyone that likely could pick those things, it would be someone like himself. And although it's impossible to pick tops and bottoms, it is possible to recognize seasons and warning signs, and recognize when the risk is elevated. I discussed this quite a bit a few months ago when the S&P hit all-time new records. Now we're seeing a stock market that's literally the most overvalued in its over 100-year history. That's not hyperbole, that's not exaggeration, and it's not alarmist. It's just a fact. Can it continue to go up from here? Of course it could. Could it correct from this point? Absolutely. When you are at extreme levels, as we are right now, whether it's to the high end or to the low end, moves are exaggerated. And this is where much of the risk is. Moves happen quickly, and with our highly connected and technological society that we're in right now, moves in the stock market can occur with lightning speed. The majority of the trades occur on a daily basis are done by computers. Microseconds, faster than any human being possibly could react. So don't be surprised if you see wide swings, increased volatility, due to the fact that we are at extreme levels. Warren Buffett is currently sitting on the largest amount of cash he ever has in his over 60-year investment career. This is not by accident. The Buffett indicator, which is a measure of stock valuations to GDP, is at the highest levels ever recorded in history. The AI narrative is what's holding up and driving the entire market. If this hype fades, we could have a brutal correction. Millions could get liquidated, jobs can be lost. This could become an historical event. To ignore these facts is to do so at your peril. In many ways, this is more extreme than even prior to the Great Depression. U.S. stock valuations, market concentration, and leverage are all now above 1929 levels. And many people think that 1929 was the biggest stock market bubble in history. Yet today's numbers are even higher. The Shiller-Cape ratio peaked at 32 in 1929. Today it's at 42, about 25% higher. The Buffett indicator in 1929 was about 95%, yet today it's over 220%, more than double. And again, the highest level ever recorded. The top 10 U.S. stocks control roughly 25% of the market in 1929. Today, those top 10 stocks control about 40% of the S&P 500. More concentration than we saw even in 1929. A small group of AI and tech companies are driving almost the entire market. And in 1929, investors famously were using heavy margin debt to buy stocks. Today, we're at leverage levels never seen before. The difference then was investors were chasing radio, automobiles, and electricity, and today they're chasing AI, semiconductors, data centers, and cloud infrastructure. The actual technologies may be different, but the story hasn't changed and the behavior hasn't either. It's human behavior we're dealing with. History doesn't repeat, but it often rhymes. And here's where things get a little bit eerie. The AI bubble is following the script as the dot-com bubble so closely, it's shocking. In December of 1994, Netscape launched and triggered the dot-com era. That was the moment that the internet went from a government project to something every person on earth could use. 875 days later, from the beginning of the dot-com era, the NASDAQ was up 144%. In November of 2022, ChatGPT launched and triggered the AI era, a technology that every person on earth could use almost overnight, and the NASDAQ began climbing almost in the exact same pattern as it did December of 1994. Here's the shocking similarities. 875 days after the birth of the internet, the NASDAQ was up 144%. 875 days since the birth of ChatGPT, the NASDAQ is up 144%. Is that coincidence? If history rhymes, we're not quite at the top yet, but we're getting really close. We are at the exact same point where what's considered the final and most dangerous phase of any cycle, and this is the climax run. The point in time when euphoria is at its highest, speculation is at its highest, and so is risk. And this is why we are now seeing the highest short interest we have seen since 2011. For those of you that are into following charts, this is a textbook Wyckoff distribution, and we're finishing the upthrust phase. Now, some of you will know what that means. For those of you that don't, this is the last and riskiest part of any bull market cycle. The big money players can't sell billions of dollars of stock just into thin air. They need buyers. So they push prices to new highs to trigger maximum FOMO, or fear of missing out, and they get retail flooding in. This is a breakout above resistance that leads to the last act before the markdown begins. And by the way, it's not just the S&P. The Russell 2000 short interest is at 5%, which is the highest in 15 years. This positioning across the entire market is screaming, we're looking at a upthrust phase that will complete when the last buyer is in. I shared last week, it goes against every fiber of human nature. The music is playing loud. The party is happening. There's enthusiasm, even euphoria. But you have to divorce yourself from your human emotions. That's extraordinarily difficult to do. I understand that. But you have to leave the party when the music is still playing loud to not get hurt. If you're not ready to give up on the upside, you believe there's still some upside ahead of us. And I'm not disagreeing with you that that's not a possibility, because it certainly is. An index annuity product could be the outstanding tool to allow you to continue to play to the upside, what most consider a most dangerous phase of any bull market cycle, the climax run. Index annuity products allow you to lock in your gains at any time. They protect your principal. Once your gain is locked in, you cannot lose those gains in the future. If you want to stay in the party because the music is still playing loud, yet you want that protection to the downside, an index annuity product is one of your best options for that. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I got some information about what this investment in AI are predicted to return over the next 5 years. I think you'll find it quite shocking.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Email Ference, F-E-R-E-N-C, no E on the end, Foxtrot, Echo, Romeo, Echo, November, Charlie, at yourpersonalbank.com or 866-268-4422. There's been a chart that's come out recently from the Financial Times that is incredibly eye-opening. And what this chart has done is looked at the top 5 companies invested in AI, the hyperscalers, as they call them, and what their implied return on investment will be based on the investments they're making into building data centers, etc., over the next 5 years. And what's really eye-opening about this Financial Times chart is their assuming positive returns on their investment under the most generous assumptions. And what that means is they're assuming zero costs. Obviously, that's not going to happen. There's going to be costs and overhead with these data centers, etc. The most optimistic positive return, according to the Financial Times, is Amazon is expected to return an investment over the next 5 years of 7.2% on their AI expenditures. Again, assuming zero costs. They're going to have some type of maintenance costs, etc. So that 7.2% return likely will be less. Every other major AI investment company anticipated returns for the next 5 years is negative. Microsoft, 9.2% to the negative. Alphabet or Google, 15% to the negative. Meta, 28% negative returns expected over the next 5 years. Oracle, 35% negative returns expected over the next 5 years, assuming they have zero overhead maintenance costs with their AI investment. Now, let's be generous, even more generous than the Financial Times, and assuming half of this turns out to be true. 4 of the 5 major companies investing in AI will likely return negative results over the next 5 years, and the only positive is Amazon, and their projections are only at 7%, which is not a very strong return for one of these tech companies. And last week, I shared some of the challenges where Microsoft, for example, had invested heavily in the company that created Claude, which is their AI, and they just canceled most of their licenses to their own engineers, stopping them from using it because it costs too much. So the company that invested heavily in this AI themselves believe it's too expensive to use. That's not a good sign. Uber burned through its entire 2026 AI budget in 4 months. They publicly stated that AI costs are getting harder to justify. And in another alarming concern or warning sign, the NVIDIA H200 chip is one of the most powerful chips to rent for AI uses. Its rental price in the past month or so has crashed from $7 an hour to $4 an hour, nearly a 50% drop. Now, why would their rental prices drop so much in such a short period of time? Either they were overpriced or there's not enough demand. And then the other argument I hear is AI itself, return on investment, is challenging at best over the next 5 years. But the orders to build the AI infrastructure is real, so let's invest in the picks and shovels companies that are building AI. Well, we were told the exact same thing during the dot-com bubble. And for a while, it was true. But when the dot-coms imploded, investors eventually realized that who's going to buy all the equipment? And the pick and shovel companies' values dropped dramatically also. Now, all this comes at a time where the U.S. households have never been more exposed to the equity markets. Americans now own a record 47% of their financial assets in equities, which is nearly triple since the 08-09 financial crisis and is 9% higher even at the peak of the dot-com bubble. And U.S. personal consumption expenditures account for about 68% of all GDP, which is also at an all-time high. So this means the future performance of the U.S. economy has never been more reliant than the performance of the stock market. A hiccup in the stock market could affect the quote-unquote real economy in a dramatic way, and it could happen really fast. These are things you need to be aware of. I am not stating and predicting that all of these things are going to occur or when, but I want you to understand that the risk is elevated when we're at these extreme levels where we, from nearly every market indicator you can measure, we're at or all near the highest levels ever recorded in the history of the markets. We're going back well over 100 years. We're in a historical period, folks. One of the interesting things, and I find I find fascinating even is we're witnessing and living history right now as we speak. There will be, in the future, financial classes and degrees will talk about these times. They'll talk about the AI bubble, much like we discussed the Great Recession or the dot-com bubble or the Great Depression. I just want you to grasp the significance of where we're at and to put things in perspective to obtain a better understanding so that you can make a better decision for yourself and not just go along with the crowd because that seems to be the thing to do. What I'm trying to say is you really need to understand where things are at and then analyze and ask yourself a simple question. What is my risk tolerance? Is this something I'm comfortable with? And the answer is for some of you listening, and the answer is yes. You closely follow, you're on top of it. I'm going to say you better be on top of things right now because, again, things could move very, very quickly. But for those of you that maybe aren't on top of watching the markets every day and paying attention to your portfolio and you're living your life, or as more and more people that are reaching out to me saying, the more I see what's going on, the more nervous I get. I'm getting nervous. I'm getting scared. I'm hearing that more and more. As this climax run continues, the longer it goes, the more and more people will become uncomfortable. It's kind of like being in a roller coaster and you're climbing that hill and you go up and up and up. And the higher you go up, the more nervous some people become. Now, there's a few folks out there that are the adrenaline junkies. They love this kind of stuff. You may be one of those, and if you are, that's okay. But I also want you to understand if you're not one of those, that's okay too. You don't need to be embarrassed by it or feel bad. I find it interesting where people will reach out to me and they'll almost like apologetically say, hey, I'm getting nervous. I'm losing sleep at night. I'm not comfortable. And I tell them, look, that's okay. That's your personality. That's who you are or the position you are in your life. Maybe when you were younger, you were more of a risk taker. That's more typical. And as a general rule of thumb, guys are more risk takers than women. And it's true, younger single guys tend to be more risk takers than, say, middle-aged or older men with families, things like that. These are all generalizations I'm making, but they tend to hold true for the most part. You have to figure out what is right for you. And where's your comfort level? Where's your risk tolerance? And as this climax run, this bubble continues to climb, this roller coaster keeps going higher and higher and higher, more and more people will be ready to get off the ride, or at least peel off a piece, lock in some of the gains. Maybe not get off the ride completely, but get off at least partially, diversify. All those things make sense, and they make good financial, logical sense. I've shared this many times. I taught a college-certified financial literacy course for a while. This is all basic financial literacy. Anyone who's ever met with a financial person and done any investing has been asked the questions about their risk tolerance. And I want you to understand there are some adrenaline junkies out there that love this. They love the roller coasters. They love the financial ride. Statistically speaking, human behavior, that's about 20% of the population. About 20% of human beings out there are adrenaline junkies, high-risk tolerance individuals. 80% are not. You looking at this, again, I'm not trying to be a fearmonger. I'm not trying to be an alarmist. What I'm trying to do is educate you to what's really going on, where we're really at. We're at historical levels. That's just a fact. Levels we've never seen ever before. They'll write books about it. I don't know if they'll write books anymore. These times will be studied in the future by future students, financial students. They'll talk about this AI bubble. And in my opinion, just like every other bubble that happened before, whether it was internet, it was the railroads, or even go back to the tulip bulb mania in the 1500s in Holland. Did you know at one point in time there were tulip bulbs that were more expensive than a house in Holland in the 1500s? See, it's not about the technology. It's about the human behavior. These cycles happen. This is nothing new. Figure out where we're at. Get a good, solid understanding. Don't put your head in the sand, but take a good, hard look at where we're at. Look at historical patterns. Look at history. Look at the signs, the warning signs, the red flags, the stuff that I've been talking about. Ask yourself a simple question. That'll help determine what you should do. And that question is, am I comfortable with this? Is this concerning to me? Do I have the ability to weather a correction, weather the storm? If it drops 20%, 30, 40, 50% even, like we have seen in previous bubbles. The NASDAQ and the .com, top to bottom, dropped over 70%. Took 15 years, roughly, for people to get back, to recover where they were. The S&P 500 in 08-09 dropped about half. Took about 5-6 years for the average person to make that back. Do you have that time? If you do, fine. If you're younger and you have that time, fine. If you're older and maybe you don't have as much time to make up for the losses, maybe you want to get off the ride or take some off the table. That's what I'm trying to say. If you want to get off this ride or take a piece off and lock in those gains, there's never been a better time for index products. It's the golden age of fixed assets. We're seeing double-digit returns with no downside risk, unlimited upside, no cap products. Yes, they exist. I find it ironic they're surprised by that. No, there's many that exist. We have products that have averaged anywhere from the low end of 7.5% to over 15% average annual returns for a decade or longer for the past 20 years. This is real, folks. This isn't hyperbole. These are actual returns. Net in your pocket. No fee or very low fee options available. Again, no cap. Unlimited upside. Contact me at yourpersonalbank.com for more information. Stay tuned in the last segment. I'm going to share a few more things that will help you understand how historic this situation we're in right now from a financial standpoint.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Foxtrot, Echo, Romeo, Echo, November, Charlie at yourpersonalbank.com or 866-268-4422. Today, I'm doing my best to help people understand how significant of a level the levels are we're seeing with the markets. We're at all-time historic levels. This is unprecedented, folks. We've never seen numbers like this. Whether it's a Buffett indicator, the Shiller index, whatever you want to measure, nearly every index, nearly every measuring tool, we're pegged it out and beyond. This is historical. And this will be historically significant and will be studied in the future by financial students, just like today we talk about the Great Recession or the dot-com bubble or even the Great Depression. That's how significant of a period of time we're in. And I'm not sharing this to scare people or to be alarmist. Trying to take a little more measured approach. If you haven't noticed, last week, maybe I came on a bit strong for some people, and for that I do apologize. But what I'm not going to apologize for is I do believe you need to know where we're at and know the facts so you can make a better decision, a more informed decision, and not just go by the hype and the emotion that we see all around us. And maybe I'm a little more attuned to this than most. This is my 27th year in the financial industry. This is my third rodeo, folks. I saw the dot-com bubble and then bust. I saw the run-up and then Great Recession occur in 0809. And now I'm seeing much of the same kind of things again. And for me, it's like a repeat. It's deja vu. Also, I paid attention to this on a daily basis because this is what I do for a living. And for me to ignore these obvious warning signs, these signals, this rhyming, if you will, of history, well, it would be foolish, for one. And to ignore this, for anyone to ignore this, well, you do so at your own peril. And I don't want you to get caught up in the hype, in the excitement, in the enthusiasm, the euphoria even, and then get burned as a result. Because those kinds of emotions don't typically make the best investment decisions. You have to use some logic. And unfortunately, from a logical standpoint, much of what we're seeing makes no sense whatsoever, other than extreme overvaluations. But let me give you a couple other points that might help even clarify where we're at even further. Warren Buffett and his team see the consumer absolutely melting down. And that's significant because about 2/3 of GDP is consumer spending. And why I say this is Berkshire Hathaway has sold their entire position in Visa. They've also sold a massive amount of MasterCard. There's a reason why they're getting out of those stocks. If you've been paying attention over the past decade or so, the companies that have had the highest profit margins, it's not the tech stocks. It's been MasterCard and Visa. There's been congressional hearings documenting that MasterCard and Visa profit margins are around 50%. Even the most profitable tech company doesn't have a 50% profit margin. So for Warren Buffett, who loves those kinds of companies, to be selling them is historic. And what is also historic is we're seeing one of the rarest market setups in over 50 years. If you look at the S&P 500's past historic drawdown since 1972, if you look at the S&P 500's past historic drawdowns over the past 50 years, in 1973, the S&P dropped 43%, and it was due primarily to high inflation. 1987 saw a 30% drop due to a liquidity crisis. 2000, we saw a 47% drop, the dot-com bubble. And in 2008 was a 55% drop in the S&P 500 due to a credit crisis that destroyed the housing market. Now, each one of those four historic drawdowns over the past 50 years were driven by one primary dominant risk. What's ironic this time is all four of those are playing out as we speak. Inflation, although not at the levels we saw in the 1970s, certainly is at the highest levels we've seen in a generation. The Fed's preferred inflation gauge has been above 2% for 18 of the last 24 months, for example. Liquidity. The three IPOs of SpaceX, OpenAI, and Anthropic are expected to raise over $275 billion combined. Google themselves has flipped from buying about $60 billion a year in their stocks to issuing about $80 billion in bonds. These are historic level liquidity events that will shock the markets. The tech bubble. Semiconductors are trading over 70% above their 200-day moving averages, which is the largest and longest stretch since 2000, the peak of the dot-com bubble. Climax signal runs are showing up all over the place and showing textbook sell patterns. Credit. We're seeing a lot of private credit drying up as we speak, whether it's Apollo, BlackRock, Cliffwater, Partners Group, and others. Never in the past 50 years have we seen all four of these risks present simultaneously. So what is going to cause the next correction? No one knows. When is it going to occur? Again, no one can say. Do these multiple risks exist? Absolutely. And the fact that we are at all-time historic levels just exaggerates that risk that much further. And one of the last points I want to make here is a former BlackRock fund manager, Ed Dowd, recently was interviewed on the stock market. And his statement was, if 45% of your market cap is AI and there's no profits yet, what are you really investing in? He stated, you're investing in future hopium. And if there's no return on investment, it becomes a bust. He finished by saying the markets can continue to be irrational longer than most people even think. But we are starting to see the narrative change fast. And that very well may be the cause that determines this next downturn. Look, markets go up, corrections occur. There's no doubt there's been a historic run in the last few years. Much of that is likely to change in the near future. I haven't even brought up the Federal Reserve. We have a new Federal Reserve chair. What are they going to do at their next meeting? Are they going to raise interest rates? Some think so. That could be a shock to the market. As I stated before, you don't necessarily need to be fearful. I think Warren Buffett probably famously said it best, is you need to be fearful when others are greedy and greedy when others are fearful. And certainly there's been a lot of greed. And you've got to ask yourself that simple question. Once you really look at where things are at, the historic levels that we're at, are you comfortable with that? What's your risk tolerance? If you lost 20, 30, 40% in your portfolio over the next few months, let's say, would you lose some sleep? Do you have the time to make up for the losses? If the market corrected and it took a year, 5, 10, 15 even maybe. The NASDAQ took that long from the dot-com bubble when it burst to when it came back. It was 15 years later before it came back to where it was. Some of the biggest tech names in the dot-com era took over 20 years to get back to their peaks. Do you have the time to wait if that were to occur? And by the way, if the market does drop, and then after that point it will recover, are you making money during that recovery period? If it's a 5 or 10 year period, let's say, are you making any money during that time frame? The answer is, of course not. You're just retracing old ground, getting back to where you were. Well, an index annuity product protects the downside. So if we continue the run up, great. You're going to continue to see double-digit returns going forward. But when the correction occurs, you lock in those gains, you don't lose. By the way, you can lock in at any time. A lot of people don't realize that. Those options exist with index products. They're far better than they were even just a few years ago. The returns are, on average, with index products with good indexes over the last 2-3 years, 2- and 3-fold higher than the ones before. I shared this last week's show, and I'll share it again. If you bought an index annuity product 2-3 years ago or more, what did the insurance company do with the money? They bought a bond. They put the bond in the safe. They never touch it. That's how they protect your principal. Then they take the interest from the bond and buy options. And when the options go up, they can go up exponentially, which means you get great returns. And if it goes down, the options expire worthless. But what does the bond do the next year? It throws off more interest. They buy more options, repeat the process. When you bought a bond 3, 5, 10 years ago, what was the interest paid on those? Very low, which means the company can only buy a few options. Therefore, the returns are going to be minimal. If you transfer or roll that over, which can be done on a tax-free basis, to a new index product, the company can buy a new bond that's likely interest rates on long-term bonds are 2 and 3 times higher than the ones even only 3 years ago. Purchase 2-3 times more options and get 2-3 times more results with the same index. I can show you index annuity products with the same company, same product, making 2 to 3 times returns now than they were 3 years ago because of when they bought the bond and how much interest the bond is throwing off, which determines how much in options they can purchase, determines how much return you're going to get. And by the way, it's not like the older bond's going to suddenly increase. Remember, when you buy a bond, a 20 or 30-year bond, it's going to pay the same interest guaranteed for the next 20, 30 years. If you're stuck in a 30-year treasury paying 2% versus a 30-year treasury paying 4.5% or 5%, that's 2-3 times more returns, isn't it? This isn't guesswork. This is math. Why continue remaining stuck in a poor-performing index product that likely will never do much more than it has in the past? It can't. Where you could transfer, roll it over, no tax. If there's a penalty, we got bonuses that offset it. If you're invested in the same thing, the returns are likely going to be 2-3 times higher. If you want more information on this, or if you just want to lock some gains in or protect your downside, the fact we're at historic highs, it's a lot of warning signs, and this is starting to make you uncomfortable. You want to reduce your risk. The risk tolerance is too high for you. If you want more information and you want to learn how to double, even triple the returns on your existing index annuity product, or you're looking at starting one, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust. I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.